Hello and welcome. You are with us on Money, Money, Money. I'm Surabhi Upadhyay, and over the next 20 odd minutes, we are going to talk about a very important part of your personal finance portfolio, the fixed income part. Why are we doing that? Well, because there's a wide belief that the best part of the interest rate down cycle perhaps is behind us. If anything, perhaps the Reserve Bank of India could start tightening monetary policy in the next calendar year. So what does this mean for your fixed income investing strategy? Do you need to reassess it? What are the funds you should have? Which are the ones that can see losses? So how do you really prepare for all of this? That is our subject of discussion. And to help us understand these concepts, we have with us Raghvendra Nath, MD at Ladderup Wealth Management. Mr. Nath, thank you very much for joining in. First of all, season's greetings to you. So everybody wants to see, really go off and enjoy their New Year party. But before that, I thought this is an important subject to sort of keep in mind, because we keep talking about the equity market run. Sometimes we get a little lazy with our fixed income investments. So first, your opening thoughts, on whether we really need to worry, whether we will indeed see a turn in the monetary policy and whether it could be disruptive for our portfolios.
Yeah, so Surabhi, I think as you very rightly said, equity market has seen an unprecedented rally, and so has the fixed income market. I remember that in August of 2019, the repo rate was somewhere around 5.4%, which last year the RBI brought it down to almost like 4%, almost 140 basis points fall over a 1 year period. And since then, RBI has maintained a very accommodative stance on the fixed income side. Monetary policy has been very easy, and with a focus on basically dealing with the pandemic as well as bolstering the economic growth in the country. So that stance of RBI continues even now, and even in the latest credit policy review in the beginning of this month, RBI actually reiterated that stance. So, but one thing is very clear, that interest rates are not falling further. So there is a kind of floor which is now established as far as rates are concerned, and from here onwards, if we were to look at, let's say, next 1 or 2 years, there is a very high likelihood that interest rates will inch up, and therefore there is a need to kind of realign a fixed income portfolio with the new realities. So people who have enjoyed a good run in in returns in their banking and PSU funds or corporate bond funds, I think they should kind of relook at those portfolios now.
Okay, so that means we do have to pay some attention and look at changes, if any are required in the portfolio. So let's start with the basics, Mr. Nath, and we've got about 17-18 minutes to get through this basic classroom. Now, we all know the inverse correlation. Every time rates rise, when yields rise, bond prices are going to fall, which means that some fixed income funds or debt funds could perhaps even see losses, right, when the rate rise actually starts happening. So you tell us which are the funds that we should be at least aware of, not panic, but be aware of that there could be mark-to-market losses, and which are the funds, if any, that may end up benefiting.
Yeah, so as you rightly said, and I think most sophisticated investors now understand that if interest rates were to go up, there'll be mark-to-market losses in their portfolios, and for a short period of time, they may see really low returns. Or if interest rates were to fall, we actually see some unnatural price gains, like the way we have seen in the last 2 months, 2 years or so. Funds where people need to be watchful of are funds which have very high average maturity. So there are funds, I know there are quite a few funds now in the market which are basically benchmarking themselves on some government security. There's a Nippon fund which benchmarks itself on a 25-year government security. Or there's a Kotak fund which is basically benchmarking itself on a 10-year government security. Now these funds, because they have very high average maturity, their sensitivity to interest rates are also high. And therefore, if interest rates were to go by, let's say, 0.5%, these a 10-year government average maturity fund can probably go down by maybe 2 or 3% percentage point immediately, and it will start kind of reflecting in negative returns over a short period of time. And in fact, we have seen that many times in the past as well. For an investor who is basically having a short investment horizon, let's say 1 year or 2 years or 3 years, it's very important that in a rising interest rate scenario, his investment horizon matches the average maturity of the portfolio. So let's say he's looking at investing for 2 years or 3 years, let's say, and then if the average maturity of the portfolio is also 3 years, then he's more or less insulated from any movement in interest rates. And that's what investors should do. They should basically look at whether they are sitting in funds which have long average maturity, like government securities or dynamic bond funds and all that, and reduce and shift over to funds which have lower average maturity.
Okay, just to simplify this even further, that some of these dynamic bond funds or gilt funds, they could be holding bonds which are maturing over long periods of time, 5, 7 years, and therefore the higher volatility. I guess that's the point that Mr. Nath is making. So, Mr. Nath, to take that point forward, now you're saying match your investment horizon with the maturity of the portfolio, that most of the bonds in that fund should mature, let's say, in 3 years, if you're looking to invest in 3 years. So, in that case, are there any options? There are two types of funds. Obviously, there are credit funds which follow this accrual strategy. So, do you only have to invest in credit funds, or can you sort of look at some kind of a hybrid strategy where there could be an element of higher rated perhaps bonds or even government paper?
Yeah, no, I think very good question, Surabhi. And credit risk funds especially have gone through a very kind of upheaval in the last 2-3 years. There were those credit events like ILNFS and SL Infra and Diwan Housing and Yes Bank and all those, and then we had all that kind of mayhem which got created when Franklin funds actually shut down. And so there is a kind of negative perception which has got created for credit risk funds. But as I see that category now, after 2-3 years, there are quite a few funds in that category which have become absolutely clean. They are well diversified. 85-90% of the portfolios are either in AA rated investments or AAA, and they actually offer much better yield than a typical corporate bond fund or banking and PSU, which is investing primarily in AAA. So I think those kind of funds can actually give you kind of a little better yield, as well as insulate you from any unprecedented volatility on the interest rates front. So that is obviously for people who are ready to take that risk. But if let's say somebody doesn't want to take that risk, they want to invest only in AAA, then probably funds like short-term funds or let's say banking and PSU, which have low average maturity, could be a fund of choice for people.
Okay, so now we're sort of getting a little more granular, and there's something for every type of investor. Just to reiterate the point Mr. Nath is making, that if you have a very low risk appetite, then don't look at credit risk funds. Then you have to stick to PSU, banking and PSU funds, or the short end of the curve, those funds. But if one is willing to look at credit risk, give us some names. That brings me to the larger questions of the funds to invest in 22. So credit risk, where we can somehow muster up our courage and venture forth in a bold manner. Which AMCs and what kind of funds are you willing to look at?
So, if you were to look at funds like, let's say, Axis Credit Risk or ICICI or HDFC or SBI, these 4-5 names, IDFC, these funds have almost 85% or more of their portfolios in AA and AAA rated investments. No exposure is more than 5-6% in the portfolio, so they are very well diversified, and they offer yields in the range of 6.5 to 7%. And the average maturity is only around 2 to 3 years. So these funds basically have a good mix of yield as well as lower average maturity, and the credit quality is generally good. So actually, while people are scared of credit risk, if you were to look at the past returns, whether you look at 2 years or 3 years or 5 years, no investor ever lost money in credit risk funds. Actually, only people who invested for very short duration were the people who lost. So actually, it's a category worth looking at right now.
Okay. Also, I didn't ask you about returns, and these are only indicative sort of discussion that we are having. Not to say that's the exact return and any investor will get, but typically these funds that you spoke of, what's the kind of return that they can perhaps generate over 3 years, the credit risk category?
So right now, if let's say if we were to look at their YTMs, I think investors can expect around 5% return, because most of these credit risk funds, have a little higher expense ratios than banking and PSU, so that eats into the yield, overall net yield to the investor. But I think around 5% is something that investors can look at.
Okay, 5% on the credit risk category. And on the banking and PSU fund side, which hold better quality paper, AAA paper, again, what's the kind of return over 3 years one can expect?
So most of these funds right now, their YTMs are under 5%. So they are around 4.7, 4.8%. So if you accounted for expenses, these funds will yield around 4% for next 3 years. So there is a difference of around 20% or so. By taking a little higher risk, you can enhance your returns from 4% to 5%.
Okay, 4 to 5% return, not exactly sounding very mouth-watering, but at least I guess there is the tax advantage if you're investing in mutual funds, right? On the other side, we'll expand the conversation. What if you don't want to invest in debt funds? Do you have any other options worth looking at in 2022 on the fixed income side? We'll put that question to Mr. Nath in just a moment. All right, welcome back. You're with us on Money, Money, Money. And this week we are discussing your fixed income investing strategy for 2022, given that we'll probably start seeing perhaps the first hint of rate hikes even here in India. Mr. Raghvendra Nath of Ladderup Wealth Management is with us on the show today. Mr. Nath, I want to talk to you about options beyond mutual funds. But before I get to that question, I think a very important question is what to ask ourselves, or what to ask any advisor who's telling us don't look at FDs. I know it's the biggest statement that, oh, you're being so lazy and it's so tax inefficient to be in a fixed deposit. Why don't you look at debt funds? So before one makes that jump, what are the 1 or 2 or 3 things that you really need to be aware of, and the questions to ask to prevent any nasty accidents along the way?
Yeah, I think the very good question. And the moment you basically the moment you move beyond the comfort of FD, where the underlying kind of sense of security is there, that okay, it's a PSU bank or it's a large private sector bank and nothing is going to happen. So there are a lot of underlying assumptions that you basically take for granted when you are investing in a fixed deposit. The moment you move out of that comfort zone and start looking at corporate bonds or perpetual bonds or market linked debentures or any investment where you are making directly to in a corporate, you have to start having an eye like you do for equities. So in the fundamentals of both equity and fixed income are the same. So unless you are investing in a company which is basically strong right now and will become stronger over the years, you are basically taking a higher risk than usual. So and that's something which is very important. So when you are investing in a company, you have to look beyond just the credit rating. So while credit rating is a good indicator of whether the company is safe or unsafe, but that's not enough, because if you were to look at the past 3 or 4 years, most of the accidents in the credit space has happened in AA and AAA rated names, and which actually offered a sense of security to people. So it is important that we look beyond that, and then do our research before investing into any name which is let's say not very familiar to us. So okay, that's something that we need to definitely look at. And the second thing is obviously liquidity, because that's another thing which the debt markets in India lack. So there are papers which may sound very attractive, but they may be completely illiquid, and therefore you need to be watchful of the liquidity before making that decision.
Okay, fair enough. So these are some of the hygiene elements you need to keep in mind. Do your homework before you part with your hard-earned money. That brings us to the wider question, Mr. Nath. What beyond mutual funds in 2022? You mentioned perpetual bonds. There could be the odd debenture issue here and there. Anything that catches your eye, something which can offer reasonable return with reasonable risk, not unreasonable risk?
Yeah, so I think perpetual, like Surabhi, is a very good category. Hasn't developed in India so much, but still because there were a few accidents earlier, like Yes Bank. But that category is a very good category globally, because all these banks and corporates which need to raise long-term debt, Perpetual becomes a good way of raising that, because it also offers investors a compelling yield. For instance, a State Bank of India perpetual bond, which has, let's say, a 4-year call or a 5-year call, is available at 6.8 or 6.9%. So, which is on the the higher side of the yield spectrum, if you were to look at. And similarly is for let's say a paper like Bank of Baroda, one of the better PSU banks in the country, and you can get upwards of 7% if you're investing in a perpetual bond of Bank of Baroda. So these so they are pardon?
Yeah, since you mentioned SBI, I just wanted to come in over here because it's a very interesting contrast and comparison.
Yes.
If I go and open a fixed deposit with State Bank of India today, I'll probably get anything between 5.5% if I'm lucky, right, on average FD rates. But you're saying the SBI
Yes.
perpetual bond, that of course is a very different instrument. I don't want to confuse our viewers, but that you're saying is yielding up to 6.7, 6.8%. You're saying. What about taxability? Because on my FD anyway, I have to pay tax as per my slab. What about the perpetual bond?
Yeah, so these are taxable bonds like fixed deposit. The difference is that in FD, you are taking there's a fixed maturity, whereas perpetual bond by nature is considered as quasi equity. It's a tier 2 capital. So bank has a choice not to call that option at the end of 5 years. And by the name, the perpetual means that the bond can be, bank can borrow for perpetuity, and that's the reason the returns are a little higher.
Okay, but I would say that if you're looking at something like State Bank of India, you mentioned BOB, you would have comfort. You would say that these could be perhaps attractive investments, at least with these PSU banks. I mean, practically near sovereign, right?
Yeah. So they are good investments because the balance sheets are good, So and that's where I was trying and telling that the moment you move beyond the comfort of an FD, you need to look at where you're investing, whether the balance sheets are strong, whether the companies are making profits, and whether those profits will become stronger over the years or not, And that's basically if the hypothesis is that the company is only going to become better or the bank is only going to become better, then they are great investments.
Okay, so we've discussed the entire gamut, debt funds, we've discussed perpetual bonds, market-linked debentures. Actually, do throw in some names if you like anything. But my other question really is on the very simple format of investing, which is actually fixed deposits or small saving schemes. Considering that rates will move up, and most of these rates are market-linked, even the small saving schemes, they're all market-linked. The rates reset themselves on a quarterly basis. So isn't it a good idea perhaps to stay invested in the simple investment itself?
Yeah, so they actually offer the small saving schemes, especially post office and RBI. They actually are offering very decent returns. So RBI taxable bond today is offering you 7.15% if you are ready to sacrifice liquidity for 7 years. So people who have long-term investment needs, these post office investments or RBI can actually become a good avenue for them, because like perpetual bonds, like FDs, they are also taxable, but because they are offering higher gross yield, your net yield is also going to be higher. And especially for people, retail investors who do not have access to high quality advisors and all that on a regular basis, basically investing and sticking with the traditional avenues of investing, of fixed income investing, should be a preferred choice.
Okay, got that. So let's sum it all up, Mr. Nath, then. Help us devise the right portfolio. I'm saying, let's say someone who's a moderate, medium risk investor, and if he or she is willing to play across the entire gamut of options that we discussed, then how would you break up his or her 100 rupees? How much in which category of funds? How much in perpetual bonds? Give us a portfolio mix.
I think around 50% of the money should be invested into, AAA rated, let's say short-term funds, banking and PSU funds, corporate bond funds and all, which basically provides the basic safety in the portfolio. And the other 50% you can play, you can look to enhance yield. So you can invest maybe 20-25% of that money into credit risk funds, which are offering you around 20% higher yields than the AAA rated options. Maybe around 10% can go into perpetual bonds, which can be held for long term, let's say 4, 5, 6 years. And maybe 10 to 15% can also go into market linked debentures, which have become other very popular investments, which are also tax efficient and actually give you around 7 to 8% after taxes. So having a mix of around 4 or 5 these kind of different categories can give you a yield of anywhere between 5.5 to 6.5 or 7% after taxes.
Okay, which is not a bad thing, I guess, at all in the current environment. All right, Mr. Nath, thank you very much for explaining all the options to us and for laying out a bit of a roadmap for our fixed income investments in 2022. Really appreciate you joining us on the show today. Well, with that, we come to the end of this week's edition of Money, Money, Money. Thanks very much for watching. News and updates continue on CNBC TV 18.